Interest rate refers to the cost of borrowing money or the return on investment expressed as a percentage of the principal amount. It is the amount charged by a lender to a borrower for the use of assets, usually calculated on an annual basis. Interest rates play a crucial role in various financial transactions, influencing borrowing and lending decisions, investment choices, and overall economic activity. There are two main types of interest rates. Simple interest. It is calculated only on the principal amount over a specific period. Compound interest. It takes into account both the principal amount and the accumulated interest from previous periods. It is more commonly used in financial transactions. Interest rates key points. Role of interest rates include borrowing and lending. Interest rates serve as the cost of borrowing for individuals, businesses, and governments. When someone borrows money, they pay interest to compensate the lender for the risk and opportunity cost of lending funds. Conversely, savers or investors earn interest as compensation for allowing others to use their funds. Investment decisions. Interest rates influence investment decisions. When interest rates are low, borrowing becomes cheaper, encouraging businesses to invest in projects and consumers to make large purchases. Conversely, higher interest rates can lead to reduced borrowing and spending. Monetary policy tool. Central banks, such as the Federal Reserve in the United States or the European Central Bank, use interest rates as a tool for monetary policy. By adjusting interest rates, central banks aim to influence inflation, employment, and overall economic growth. Types of interest rates include nominal interest rate. The nominal interest rate is the stated rate on a financial product, such as a loan or a bond. It does not account for inflation. Real interest rate. The real interest rate is adjusted for inflation. It reflects the actual purchasing power gained or lost through borrowing or lending. Factors influencing interest rates include inflation. Generally, interest rates tend to rise when inflation is high to maintain the purchasing power of money. Central banks may increase interest rates to control inflation. Central bank policies. Central banks set short-term interest rates as part of their monetary policy. Adjustments in these rates influence borrowing costs and, consequently, spending and investment. Economic conditions. Interest rates can be affected by the overall economic environment. During economic expansions, central banks may raise rates to prevent overheating, while during recessions, they might lower rates to stimulate economic activity. Credit risk. The perceived creditworthiness of borrowers affects the interest rates they are offered. Individuals or entities with higher credit risk may face higher interest rates to compensate lenders for the increased likelihood of default. Effect on financial markets include bond prices. Interest rates and bond prices have an inverse relationship. When interest rates rise, the prices of existing bonds tend to fall, and vice versa. This is known as interest rate risk. Stock market. Changes in interest rates can influence stock prices. For example, higher interest rates may make fixed income investments more attractive, potentially leading to a decrease in stock prices. Understanding interest rates is crucial for making informed financial decisions, whether it involves taking out loans, making investments, or assessing the overall economic environment. The complex interplay of factors influencing interest rates requires careful consideration by individuals, businesses, and policymakers alike.